24%. That is the number I want you to hold in your head for the next 20 minutes, because by the time we are done here, you are going to understand exactly why that single figure is the most important number in the silver market right now, and why most people who own silver have never even heard of it. Last week I told you to watch the dollar index around the 100 level and whether it held or broke. As of this recording, the DXY is sitting at 99.67. It did crack below 100, which is exactly the setup I said to watch for. That matters for what we are covering today, and I will show you precisely why in a few minutes. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I sat in rooms where these decisions get made. I watched what happens when retail investors are working with the wrong framework at exactly the wrong moment. That is why this channel exists, to give the people watching their savings from home the same quality of analysis the institutions are running internally. Everything I show you today comes from publicly available sources, and I will name every single one as we go. Today we are covering three things: what the warehouse coverage ratio actually is, and why 24% should be getting more attention than it is, what the current gap between paper silver and physical silver in Asia is telling us about where real price discovery is happening right now, and how to think about your own position in this market using a framework that separates the signal from the noise. If that is the kind of breakdown you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, today is a good day to fix that, because what we are building here is a week-by-week picture of these markets. And this week's video connects directly to what is coming next. Quick question before we go any further. Drop this in the comments right now. Are you holding physical silver, mining stocks, a silver ETF, or some combination? I ask because the answer to that question completely changes which part of today's video matters most to you. The comment section here becomes a real-time snapshot of what serious silver holders are actually doing, and I read every single one. Let me set the scene on where silver actually is right now, because the price you see on your screen is only part of the story, and increasingly, it may be the less important part. Spot silver, the paper price, the number quoted on every financial site in the US and UK, is sitting at $69.84 as of this recording. That number is set primarily on the COMEX futures exchange in New York. It is the number your broker shows you. It is the number the financial press reports. Now here is where it gets interesting. If you are a buyer of physical silver in Shanghai right now, and there are a lot of them, you are not paying $69.84. You are paying $81.25. That is the price on the Shanghai Gold Exchange for physical metal. The gap between those two numbers is 11.41. As a percentage, that is a 16.34% premium. And that is one of the highest premiums recorded in the 2026 trade cycle. Think about what that means in plain terms. The same ounce of silver, same purity, same metal, has two prices right now depending on whether you are buying a paper claim to it in New York or actual physical metal in Shanghai. That gap is not supposed to exist at that size. In normal functioning markets, arbitrage, traders buying cheap in one place and selling expensive in another, closes that gap quickly. The fact that it is not closing tells you something is structurally different about the current setup, and that something is what today's video is actually about. So let us talk about the warehouse coverage ratio, the 24% figure, because this is the number that ties everything together, and it is genuinely one of the more striking data points I have seen in this market in some time. Here is how to think about it. COMEX is the primary futures exchange where silver is traded in the West. When you buy a silver futures contract, you are buying a legal claim to a specific amount of silver. Theoretically, if you hold that contract to expiration and demand delivery, you should be able to walk away with physical metal. That is the foundation the whole system rests on. Now, COMEX tracks its warehouse inventory in two categories. There is eligible silver, metal sitting in approved vaults that meets COMEX standards, but has not been specifically earmarked to back a futures contract. And there is registered silver, metal that has been officially designated to back futures contracts and is available for delivery. When people talk about the warehouse coverage ratio, they are talking about registered silver versus total open interest, the total number of active futures contracts that could theoretically demand delivery. Right now, according to CME warehouse report data, registered silver sits at approximately 103 million ounces. That sounds like a lot, and in isolation it is, but here is the other side of that equation. Total open interest on COMEX silver sits at 115,458 contracts. Each contract represents 5,000 ounces. Do that math and you get over 575 million ounces of paper silver out there in the form of active futures positions. 103 million ounces of registered physical silver backing over 575 million ounces of paper claims. That is your 24% warehouse coverage ratio. Here is an analogy that makes it immediate. Imagine a coat check at a very popular restaurant. They give out 575 tickets, but there are only 103 coats actually hanging in the back. As long as nobody asks for their coat at the same time, the system runs fine. The moment a significant number of people start asking for their actual coat, not a ticket, not a promise, the coat, you have a problem. Now, in normal times, most futures contracts never go to delivery. Traders roll them, close them out, take cash settlement. The system is designed around the assumption that only a small percentage will ever demand the physical metal. That assumption has held for decades. What the current data is suggesting is that the assumption may be under more pressure than usual right now. The CFTC, the Commodity Futures Trading Commission, which publishes weekly positioning data every Friday, shows that institutional players are increasingly requesting physical delivery rather than rolling their contracts forward. That is a behavior shift, and behavior shifts in these markets are worth paying attention to. Now, here is something I want to be straight about because this is where a lot of channels in this space get sloppy, and I am not going to do that to you. A low warehouse coverage ratio does not automatically mean COMEX is about to default or that the system is broken. I want to be clear about that. The ratio has been low before. Institutions have navigated it before. What it does mean is that the buffer, the margin of safety, between paper promises and physical reality is thinner than it has been. And when that buffer thins out at the same time, you are seeing a 16% physical premium in Asia, and at the same time, you are seeing delivery requests increasing. Those three things together create a setup worth watching closely. Each one of them, individually, could be explained away. All three pointing in the same direction at the same time is harder to dismiss. If you know someone who has been trying to make sense of the silver market this week, forward this video to them right now. This breakdown took real time to put together, and the people who need it most are often not the ones searching for it. Let me bring in the geopolitical layer here because what is happening in Asia is not random, and it does not exist in a vacuum. The Shanghai Gold Exchange premium, that 1141 gap we talked about, is partly a function of genuine physical demand from industrial buyers in China. China is the world's largest manufacturer of solar panels. Solar panels require silver. The energy transition is not a future event in China. It is a current, scaled industrial reality. When manufacturers need silver for production and the local price reflects genuine scarcity of available physical metal, that premium is a real signal, not a speculative one. Now, before you run with that, and this is important, premiums on the Shanghai Exchange can also reflect local taxes, import duties, financing costs, and the specific structure of that market versus Western exchanges. So a straight apples-to-apples comparison between the COMEX paper price and the SGE physical price requires some nuance. A portion of that gap is structural, but even accounting for all of that, a 16% premium is extraordinary. You cannot explain all of that with taxes and financing costs. Some of it is genuine physical demand outpacing available supply in the Asian market. And here is the macro backdrop that makes this more significant. The dollar index at 99.67, breaking below that 100 level I flagged last week, is acting as a ceiling on the paper silver price. A weaker dollar typically supports commodity prices because commodities are dollar-denominated globally. The fact that silver's paper price has not reacted more aggressively to dollar weakness while physical premiums are exploding in Asia tells you something about where the real price tension is building. On the UK side, and this matters for our British viewers, the London Bullion Market Association, the LBMA, is the primary pricing benchmark for physical gold and silver in Europe. LBMA vault activity and any divergence between LBMA and COMEX pricing is worth watching as this situation develops. The Bank of England holds significant gold reserves, and any movement in Western institutional attitudes toward physical metal as a reserve asset will show up in LBMA data before it shows up anywhere else. I will be watching that closely in the weeks ahead. Let us talk about the industrial demand picture, because this is the part of the silver story that does not get enough analytical attention. Silver is not like gold in one critical way. The majority of gold that gets mined ends up as jewelry in vaults or in financial instruments. It is mostly above ground and mostly recoverable. Silver is different. A significant portion of silver demand is industrial, and much of that industrial silver is used in such small quantities across so many different products that it is genuinely difficult to recycle economically. It disperses. Think about every solar panel, every electric vehicle component, every medical device, every connector, and every piece of electronics you own. Silver is in all of them. It is not visible, it is not recoverable in any practical sense at scale. The Silver Institute, which publishes the most comprehensive annual supply and demand data for the silver market, has documented multiple consecutive years of structural supply deficits in silver. That means the world is consuming more silver than it is mining. Now, I am not going to give you a precise ounce per megawatt figure for solar demand because that would be false precision, and you deserve better than that. What I can tell you is that the direction of industrial demand has not reversed. Solar deployment is scaling. AI hardware, the physical server infrastructure, the connectors, the components, requires silver. These are not speculative future demands. They are current, documented, growing consumption patterns. In the UK context, the North Sea energy transition and the UK government's solar rollout commitments mean British industrial silver consumption is also a part of this global picture. The direction of that demand is not ambiguous. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market, what the futures and positioning data are telling us. Lane 2 is the physical market, what premiums, inventory, and delivery behavior are showing us. Lane 3 is macro, what the dollar, rates, and central bank behavior are doing. Right now, the paper lane is showing us a warehouse coverage ratio of 24% with increasing delivery requests from institutional players. That is a tightening signal in the futures infrastructure. The physical lane is showing us a 16% premium on the Shanghai Gold Exchange and a registered inventory figure of 103 million ounces, sitting against over 575 million ounces of paper claims. That is a stress signal in the supply chain. The macro lane is showing us a DXY that just broke below 100, which historically has been supportive for silver prices, and central bank reserve diversification continuing as a multi-year structural trend. That is a tailwind signal for hard assets broadly. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes pointing in the same direction, even briefly, have historically preceded some of the most significant moves in these markets. I am not saying all 3 are in perfect alignment today. The paper market still has significant mechanical pressure it can exert on the headline price. What I am saying is that the direction of pressure across all 3 lanes is worth knowing, and right now all 3 are pointing at the same underlying tension. When the paper lane is showing infrastructure stress while the physical lane is showing a historic premium and the macro lane is providing a dollar tailwind, the historical pattern has been that the physical reality eventually reasserts itself into the paper price. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. The COMEX registered silver inventory figure updated daily on the CME Group's official warehouse report. I am watching whether that 103 million ounce figure holds steady, builds, or declines. If registered inventory starts declining meaningfully, even by 5 to 10 million ounces, while open interest stays elevated, that coverage ratio tightens further, and the structural case we have been building throughout this video becomes more acute. If inventory builds, that tells you metal is moving back into registered status, and the immediate stress is easing. The CME updates this data every business day. The next meaningful read will come this week. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that. Here is the honest bull picture. If institutional delivery requests continue accelerating and registered inventory does not rebuild, the mechanical pressure on the paper price becomes very difficult to contain. In that scenario, a move toward the $80 level, which is already the physical price being paid in Shanghai today, becomes a genuine possibility rather than a speculative target. The physical market would effectively be dragging the paper price upward. Here is the honest bear picture. Silver remains a relatively small market. A broad risk-off event, equity market liquidation, a credit event, a sudden dollar reversal, could trigger forced selling across commodity markets regardless of the physical supply picture. We saw exactly that dynamic in March 2020. Physical fundamentals did not prevent a sharp drawdown. Macro liquidity conditions overwhelmed the supply story temporarily. A move towards $65 support in that scenario is not unreasonable to model, even with everything we have discussed today. Both of these outcomes are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing. The inventory data, the premium data, the positioning data, and let the market tell you what is happening in real time. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers, not just a thumbs up. First, right now, are you holding your silver position, adding to it, or have you trimmed anything in the last 30 days? Second, when you look at that 16% gap between paper price and physical price in Shanghai, do you read that as a buy signal, a warning signal, or something else entirely? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe, because next week we are going directly into the CFTC positioning data. I'm going to show you exactly how to read the Commitment of Traders report yourself, line by line, so you never have to rely on someone else's interpretation of it again. That is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening in these markets, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.